Welcome to Becoming Bossy. Class is in session. If you're studying for this Certified Public Accountant exam or this Certified Internal Auditor exam, then you will need to know the key topics shared in this video. Today, we will discuss questions surrounding financial management, financial ratios, and areas of accounting that may seem a little scary, but no worries. I'll provide detailed answer explanations for each question. If you want to learn the basics of accounting first, check out the previous video that I published right before this one. Without further delay, let's hop into some questions. Number 1, which of the outcomes represented in the following table would result from a company's retirement of debt with excess cash? So keywords here, we're looking at a company's retirement. That means that they are paying all their debt with extra cash that they have on hand. So the first column, we have total assets turnover ratio. Second column, we have the interest earned ratio. So what is assets turnover ratio? That is net sales divided by average total assets. And what's the formula for interest earned ratio? It is EBITDA divided by interest expense. If you don't know what EBITDA is, that is earnings before interest, taxes, depreciation, and amortization. You will shortly learn this like the back of your hand after a while, after dealing with a lot of these questions. So because cash is a part of total assets, we know that total assets will decline due to this transaction and will not have an impact on sales. So the total assets turnover ratio will therefore increase. So remember, the total assets turnover ratio is net sales, which will not change by this transaction, divided by average total assets. Average total assets will decrease because we're giving away cash. So that means that the numerator of the equation will actually go up, and that means that the assets turnover ratio will increase. So we can eliminate C or D, so it has to be either A or B now. So now we look at the following period's interest earned ratio. So a reduced debt level should cause a reduction in annual interest payments paid on debt. So this means that the times interest earned ratio should also increase. So let's think about it again. We know the interest earned ratio is EBITDA divided by what? Yep, divided by interest expense. So if interest expense goes down because we're reducing our debt and therefore our interest expense goes down, then the numerator of the equation will go up. And that means that the ratio for interest earned will also go up. So the answer is A. The assets turnover ratio will increase and the following period's interest earned ratio will also increase. Good job. That was a tough one. Number 2, the following selected data pertains to Bossy Company at December 31st, 2022. So here we have a lot of information about quick assets, about the asset test ratio, current ratio, net sales, cost of sales, and average total assets. So the key to answering these questions without really reading everything at one time is to figure out what they're looking for. So if we go to the question at hand, they are asking us, based on the above, what are the company's current liabilities at the end of the year? So that's what they want to find out, current liabilities. Now, we can only answer this question if we know what quick assets are, what all these other terms are, like asset test ratio, current ratio, etc. What we do know is that net sales and cost of sales and average total assets really doesn't have anything to do with current liabilities. However, we do know that current liabilities are actually a part of the asset test ratio, right? And technically it's also part of the current ratio. But we can't use the current ratio because we don't know the current assets. We just know the average total assets. So let's see if we can use the asset test ratio to help us answer this question. So we know that the asset test ratio equals quick assets divided by current liabilities, which is what we're trying to figure out. Quick assets are current assets minus inventory, and we have that given in the question. So therefore, we can solve for current liabilities. So just a definition of quick assets. When you think of quick, think of assets that can quickly be converted to cash, right? So think about accounts receivable, think about marketable securities, but don't think about inventory because inventory may take a long time to actually get cash from it. So since quick assets of $208,000 is given and the asset test ratio is 2.6, which is also given in the clues, we can divide $208,000 by 2.6 to get current liabilities of $80,000. So we have our answer, $80,000. Next question. So here we have a balance sheet and income statement for two companies, Company A and Company B. I know that our first inclination is to try to look at the balance sheet, look at the amounts, look at the income statement, look at those amounts. But no, I do not suggest you do that because you have limited time and you only have a little over a minute to answer each question. So first, what you should do is actually read the question. So based on 365 days per year, Company B has days sales outstanding to the nearest full estate of A, 0 days, B, 3 days, C, 6 days, or D, 7 days. So first things first, the question actually gives you a hint. It says based on 365 days per year. So you're actually going to need that amount. And next, if you know what days to sales outstanding is, that is accounts receivable divided by average sales per day. So where do you find accounts receivable? Well, that's in your balance sheet, and they give you the amount for Company B. Also, when they give you information for two companies or more companies, figure out which one they are asking for. Are they asking for Company A or Company B? That will help you make smarter decisions and to avoid making mistakes when selecting your answers. So Company B has accounts receivable of $100, and then we know that sales are $5,800, and we're going to divide that by 365 days per year to get the average sales per day. So your formula will be 100 divided by 5,800 divided by 365. So first we'll do 5,800 divided by 365, and that will be 15.89. And then we'll do 100 divided by 15.89. And remember, we have to round it to the nearest day. That gets us to 6 days. So the answer is C, 6 days. That is the days still outstanding. Okay. Number 4, a company decided to sell a line of its business. The assets were sold for $100,000 and had a net book value of $70,000. The applicable tax rate was 20%. The result of this transaction will appear on the A, balance sheet as a prior period adjustment, B, income statement as an extraordinary item, C, income statement as discontinued operations, or D, income statement as an accounting change. So notice that they give you all of this quantitative information about what assets are, what the book value is, what the tax rate is. You really don't even need that. All you need to do is understand what the transaction is and how it affects the financial statements. So, since this is a sale of a business that is no longer in operations, we know that it will affect income. It will affect income, so we know that A is automatically eliminated. So we've narrowed our answers down to 3 choices. We know that it impacts the income statement primarily. And what is an extraordinary item in B? So an extraordinary item is a transaction that is non-recurring and is not consistent with the course of the business's operations. So sale of inventory would not be an extraordinary item, but loss of a store or warehouse due to a tornado or a natural disaster probably would be an extraordinary item. So when you see extraordinary item, think of something that is rare, that doesn't align with the business operations, that is very unusual, and typically could also be very high in dollar amount as well. So we know that's not B. And then C, income statement as discontinued operations, well, this is a sale of a business, which is a discontinued operation. So this could qualify, but let's not be too hasty yet. Let's look at what D says. D, income statement as an accounting change. So accounting changes could be like going from FIFO to LIFO accounting, or going from GAAP to cash basis or accrual basis. So we know that's not an accounting change. So C, income statement as discontinued operations, is in fact the answer. Next, a company sells goods on an installment basis. The table below includes information about the level of installment sales, the cost of the goods sold on installment, and the cash receipts on installment sales for 2010 through 2012. All cash receipt amounts shown are net of any interest charges. So we have information about installment sales, the cost of installment sales, and then some random cash receipts from the 90s. So when we think of gross profit, we know that it is income minus cost of goods sold, right? Or in this case, it would be installment sales minus cost of installment sales. The cash receipts is just something to distract you in the question. And again, make sure that you are selecting the correct year. So be careful when you have multiple years that are presented in the question. We're looking at 2011, not 2010, or not 2012. So 2011, we have sales of $5,000, cost of installment sales of $4,000. So the rate of gross profit is actually $5,000 sales minus $4,000 of cost of sales, which is $1,000, divided by total sales of $5,000. So 1 divided by 5 gives us 20%. The answer is A, 20%. Next, an impressed bank account is A, a difference between the amount on deposit according to the company's records and the amount of collected cash according to the bank record. B, the principal bank account through which most companies' cash transactions are recycled. C, an account used to make a specific amount of cash available for a limited purpose. Or D, a local post office box from which a local bank is authorized to pick up and deposit remittances. So quickly, we can eliminate a few things. D, a local post office box? No, that is not true. That would most likely be like a lockbox where you put in payments. That's not an impressed bank account. And then a difference between an amount of deposit according to the company's records and the amount collected cash according to the bank record. No, that sounds like a bank reconciliation. So it's not A, it's not D. And then B says the principal bank account through which most companies' transactions are cycled. No, that's not an impressed bank account. That sounds like the main bank account that a company would use. It's actually C. An impressed account is actually a bank account that is used specifically for limited purposes. So it could just be for a certain project or for a certain vendor or for certain types of transactions. So C is the answer here. All right, next, a company whose balance sheet is presented in Table A had the following results of operations for the year ended December 31st, 2022. So here we have some income numbers: sales, cost of goods sold, net operating income, net income. Then it tells us a lot of information actually. So Table A also has the balance sheet amounts. So we have a ton of numbers to work with here. But the question, again, go straight to the question when you see all these numbers, is asking us, based on the information above and provided, the company's return on operating assets is. So it's looking for the return of operating assets, and keyword, operating assets. So when we think about operating assets, we think about assets that actually have everything to do with the business's main line of business, not any extracurricular activities that the company may partake in. So no investment things or nothing that doesn't have to do with their core operations. Got it? All right, so we know that return on operating assets is net operating income divided by net operating assets. So that information is actually provided in our income statement and our balance sheet. So net operating income $1.75 million divided by net operating assets of, we have a few things here for net operating assets. We have total current assets of $2.5 million, and then we have net plant and equipment of $5 million. Don't be fooled. We will not include goodwill because goodwill is typically something that is given to a company based on a purchase of another company or some kind of business combination activity. So we will not include goodwill in the net operating assets amount. So our net operating assets will be $7.5 million. So we have 1.75 divided by 7.5. And that gives us 23.33%. So the answer is C. All right. Moving on. A multinational company operates a production facility in country A and a distribution outlet in country B. The tax rates are 40% in country A and 50% in country B. The production facility sells the goods to the distribution outlet, both of which are wholly owned by the multinational company. The internal sale of goods occurs at a transfer price set by the multinational company. Assuming no non-tax considerations and no interference from the tax authorities of the two countries, the company should A. maximize the transfer price, B. minimize the transfer price, C. establish a transfer price that results in the same profit margin for both operations, or D. use a transfer price based on the market price for the product that the other producers charge. Okay, so we can eliminate a few things. The reason why they're telling you the tax rates is important. We know that country A has a tax rate of 40%, country B has a tax rate of 50%. So basically, the more business that you have in country A will result in less taxes, and that'll be better income for your company. So knowing that, the answer is A, you should maximize the transfer price. The country where the producer is located has the lower tax rate, country A, so the overall tax burden is lowered by maximizing the transfer price. This will also maximize the reportable taxable income in that company A, lower tax country, by maximizing revenue, and also it will minimize reported taxable income in the lower tax country by maximizing expenses. So, A is the answer. Number 9. If depreciation was materially overstated, an error in the prior year, the correction in the following year when the error is detected will involve A. increasing reported earnings for the current year, B. decreasing reported earnings for the current year, C. increasing the opening balance of retained earnings for the current year, or D. decreasing the opening balance of retained earnings for the current year. So, what's happening here? We have depreciation that was overstated last year, in error. So a correction has to be made. So typically at the end of the year, this is a good way to go about answering this question. At the end of the year, typically all income statement accounts, such as depreciation expense, are closed to your retained earnings, right? Because literally retained earnings includes the net income that occurred in the previous year, right? So that depreciation expense would also be included in retained earnings. So that leaves us with either C or D. We know that a correction has to be made to retained earnings. Now, since depreciation was overstated, that means that our income was understated, right? So this means that we should have higher retained earnings than what is currently reported. So the answer is C, increasing the opening balance of retained earnings for the current year. If depreciation was overstated in the prior year, the net income was understated. The correction involves increasing the opening balance of retained earnings for the current year. All right, number 10. A company has 7,000 obsolete toys, which are carried in inventory at a manufacturing cost of $6 per unit. If the toys are reworked for $2 per unit, they could be sold for $3 per unit. If the toys are scrapped, they could be sold for $1.85 per unit. Which alternative is more desirable, rework or scrap? And what is the total dollar amount for the advantage of that alternative? So A, should they scrap it and get an advantage of $5,950? Should they B, rework it, get an advantage of $36,050? Should they C, scrap and get an advantage of $47,950? Or should they D, rework and get an advantage of $8,050? So what is the question asking us? We have to make these decisions like we're a manufacturing manager. Should we rework the products or should we scrap them? So rework means that you're going to put in a little more labor and effort to get the unit to a more desirable quality. Scrap means that you're going to just get rid of it, sell it for what it is as is, right? So some things to consider here in this question. They're giving you more information than you need to know. We do not need to know what the manufacturing cost is. Think of that as a sunk cost. It does not play a role in our determination of whether we should rework the item or scrap the item. So we do need to know all the other information. To calculate the advantage of an alternative, what you need to do is figure out what is the difference between the two alternatives. So we know that if we were to rework the item, right, we would sell it for $3. So $3 times 7,000 units is 21,000. And then we would have to incur $2 per unit. So $2 per 7,000 toys is 14,000. So 21,000 minus 14,000, we would get $7,000 for rework, right? If we decide to scrap, we would get $7,000 times $1.85, which would be $12,950, right? So which one is higher? I think we should go with scrap because scrap will give us $12,950 compared to rework $7,000. So we know that the advantage is scrap. What is the amount? That's easy. We just do $12,950 minus $7,000. We get our advantage of $5,950. So the answer is A. Next question. A company manufactures and sells a single product. It takes 2 machine hours to produce 1 unit. Annual sales are expected to be 75,000 units. Annual production capacity is 200,000 machine hours. Expected selling price is $10 per unit. Cost data for manufacturing and selling the product are, and we get variable costs, direct materials, direct labor, and other information. Then we have some fixed costs, fixed selling, etc. But let's get to the question. It says the company receives a special order of 10,000 units at $7.60. Variable selling costs for each of these 10,000 units will be $1.20. The special order will not affect regular sales of 75,000 units. If the company accepts this special order, its profit will A, increase by $8,000, B, increase by $16,000, C, decrease by $4,000, or D, decrease by $12,000. All right, let's go ahead and solve this. So we know that profit is gross sales minus cost of goods sold, right? Well, gross sales is 10,000 units at $7.6. So we have 10,000 times 7.6, that's $76,000 are our gross sales, right? Now let's calculate cost of goods sold. So we know that we have variable costs, right? And it tells us that variable selling costs are $1.20 per unit at 10,000 units. So 10,000 times 1.2, we know that's 12,000, right? But there are other variable selling costs as well. We have variable direct materials, and we have variable direct labor, and we have variable manufacturing overhead. Now we can exclude the variable selling cost of $2 that's presented here because that's why they told us in the question that there's a different variable selling cost for these special order units, right? So we are going to add the 1.2 from the question for our variable selling costs. We're going to add $3 for our direct materials, add $1 for our direct labor, and add manufacturing overhead for our variable amount of 80 cents per unit. So if we add all of that together, we will get $6 per unit. So our variable costs per unit are $6. $6 times 10,000 units is $60,000. So that's 76,000 gross sales minus our cost of goods sold, only variable, right? Only variable of 60,000 is $16,000. So our answer here is that the profit will increase by $16,000. It will increase because gross sales are higher than the variable selling costs. And remember, we are not including fixed costs because fixed costs are not a major player when you're making those decisions about selling or making or about incremental changes such as reworking or scrapping. We do not consider fixed costs. Think of those as sunk costs as well, okay? So the answer here is B, $16,000 increase. Next. All right. A new company requires $1 million of financing and is considering two arrangements as shown in the table below. And here we have arrangement 1, arrangement 2. It tells us the amount of equity raised, the amount of debt financing, and the before tax cost of debt. All right. In the first year of operations, the company is expected to have sales revenue of $500,000, cost of sales of $200,000, and G&A expenses of $100,000. The tax rate is 30%, and there are no other items on the income statement. All earnings are paid out as dividends at the year end. If the cost of equity is 12% and the weighted average cost of capital under arrangement 1 to the nearest full percentage point would be A, 8%, B, 10%, C, 11%, or 12%, D. So a few things here. How do we calculate weighted average cost of capital? Because that's what they're asking us. So, like I said, to be expedient in answering these questions, don't even look at all the numbers. Go straight to the question. Figure out what you need to solve for. What is it asking us to get? So we need to get the weighted average cost of capital. We know that formula is weight of equity times cost of equity plus weight of debt times before tax cost of debt times 1 minus the tax rate. Because you need to get the after tax effect of the debt capital, right? So we have weight of equity of 70% or 0.7, which is calculated by finding the $700,000 divided by the total 1,700,000 plus 300,000. And so that weight of equity is 0.7 times your cost of equity, which should tell us is 12%. So that's 0.12. And that gives us total cost of equity times weight of equity is 0.084 or 8.4%. And now we need to find the after-tax rate of the debt. So that is going to be $300,000 of debt divided by 1,000,000, 30%. So that's 30% times 8% per annum times 1 minus 30% tax rate. So that will give us 0.0168 or 1.68%. So if we add the equity plus the debt, we will get the weighted average cost of capital, which is that 0.084 plus 0.0168 equals 10% when it is rounded, because we need to get it to the nearest full percentage point. So the answer here is B. All right. Moving on to the next question. The following transactions occurred during a company's first year of operations. They purchased a delivery van for cash, they borrowed money by issuance of short-term debt, and they purchased treasury stock. Which of the items above caused a change in the amount of working capital? Working capital is simply current assets minus current liabilities. So let's look at each transaction. Purchasing a delivery van for cash, that means that you are giving away cash, which is a current asset. So that is reducing a current asset, cash, and it has no effect on current liabilities. So it will result in a reduced working capital, right? So we know that is one of the answers. Next, borrowed money by issuance of short-term debt. Short-term debt is a current liability, right? But guess what? you're borrowing money. So you're also getting a current asset of the same amount. This will neither increase or decrease working capital. It has no effect on working capital. Next, third, purchased treasury stock. So we know that purchasing treasury stock will actually decrease our current assets because we're getting this investment based on the money, the cash that we put out. So we're again giving away cash, which is a current asset. So we are reducing our working capital. Therefore, it will reduce working capital, and our answers are 1 and 3. All right, I really hope that this lesson of practice questions really helped you understand a lot of the concepts that you'll see maybe in, FAR on the CPA exam, and maybe even also financial management of the third part of the Certified Internal Auditor exam. I thank you for watching. Stay blessed and stay bossy. And also hit that subscribe button if you want more videos. And comment if you learned a lot, if you have any more questions, if you feel like I didn't explain something correctly, or if you still have questions about a particular question that I have in the video, let me know. I will be sure to get back to you and answer your question. All right. Thank you. Bye.